So let's get started on this very exciting topic of how to start building your credit. So this is a topic that we talk about a lot, credit in general. But we often get this question when we're talking to people about their credit reports of, well, how am I supposed to start building credit, or how can I build my credit in general? So we figured this might be a good topic to go off of. Let me introduce myself real quick if you haven't been here before. My name is Bailey Parker, and I'm the Communications Director here at the South Carolina Department of Consumer Affairs. Been here for 4.5 years now, and I am usually the one that is on here talking about credit. If you've been here before, you've seen this whole spiel, but I'm not an attorney. You don't want legal advice from me. It'd be really bad advice. This presentation is not meant to serve as a substitute for reading the various laws discussed. We're not going to be talking about any specific laws today, so that doesn't apply, but this presentation is merely serving as an introduction and overview of the topic. Okay, so this is where we're headed today. So first, we're going to talk about what is credit, because the word credit is thrown around a lot. It applies to a lot of different things, and I think people can get confused when we talk about credit reports, credit scores, credit cards, credit loans. What's the difference? What is credit as a whole? So we'll kind of parse out some of those details. And then what is credit needed for? What do we need it for? And then also, why do we even need to start building credit? That may seem like a silly question, but I think it's something important that we need to go over to really delve into this topic. And then the common complaint that I get from consumers is this catch-22 of credit. We'll go over that in the middle. And then the bulk of the presentation is how can you actually start building your credit? And then we'll go over a few resources at the end. So credit reports, scores, oh my. So you may have been here at one of the presentations in the past. We talk a lot about credit here at Consumer Affairs because we do regulate a number of credit related industries here at the agency. So you may have been to one of our webinars in the past that have talked about credit reports or scores. And we have a lot of webinars on our YouTube channel that you can go and watch. You might have questions about reports specifically or scores, how are they calculated? Chances are we probably have a webinar that covers that specific topic. So you can go and watch those. It's on youtube.com/SCDCA TV, or you can just go to youtube.com and search SCDCA TV. Here are just 3 of the credit related topics that are in our webinar playlist on there. So credit reports and scores demystified, and then credit reporting updates for medical debt, and then what to know before paying for credit repair. So again, we talk a lot about credit here at Consumer Affairs. So this is just a little snippet of some of the webinars that we have on our YouTube that you can go and watch if you're interested in that. So let's get into this. What is credit in general? So it's not just credit cards. I think that's the first thing that people think of when you hear the word credit, or score. It's credit card or credit score. I think that's what we most think of. But credit in general as a concept is borrowing money to use now with the promise and obligation. It is an obligation to pay it back later. A not so fancy word for obligation would be you're required to pay it back. It's mandatory. It's not a choice to pay it back. So credit also is how likely you are to pay something back. So if you have good credit, a creditor, which is somebody who would give you credit, might think that you are easier to trust. If you have bad credit, you might be considered harder to trust. So this is just the general concept of credit here. And then it's buy now, pay later. That's really all credit. So no matter what type of credit it is, you are buying it now. You're getting some sort of credit, loan, whether it's a card, money, loan, mortgage, whatever it may be, and you're paying for it later, whether it's through an installment loan or a revolving loan, whatever that may be, you're going to end up paying for it later. And I often get a question of, okay, so we know what credit is. It's any sort of borrowed money that I have to pay back. But what about reports and scores? So I mentioned that you can go and watch those webinars, and I'm not going to go into too much detail here, but I am going to touch on this a little bit when we get into the building credit. So I did want to just show these few slides here. There is a difference between reports and scores. They're not the same thing. Now, they work together, but they're not the same thing. So your report is a reflection of your credit activity. Your credit activity is, are you paying your bills? How many loans do you have? How many credit cards have you applied for? So the activity that you're taking when it comes to your credit is on your credit report. Then your score is a calculation of the activity on your credit report. So a lot of people don't know that when you pull your real credit report, so your actual hard credit report, it does not come with a score. And people will say, well, Bailey, when I go to my credit card company and they show me my credit report, it comes with a score. That's not your actual credit score, just to let you know. That's not your true credit score. They are giving you an estimate. And that's okay. The estimate's still good. But I'm just letting you know that your true credit score is not going to come with your credit report. You often will have to pay for your true credit score. So just to let you know, they are two separate things here. And this will come up when we go into the building the credit. So what is technically on that credit report? So it's that detailed record of how you've managed that credit over time. And there's a lot of information on this. So there's three major credit reporting agencies. You've got Experian, TransUnion, and Equifax. They're getting information from all of your creditors. So those creditors are the people that are loaning you things, right? And if you are attempting to build credit, they're people you want to have you loan things. So your creditors or future creditors are going to talk to the credit reporting agencies, and they are going to give them your information about your payment history, your application history, and then also there's going to be public records, and that's going to all be compiled into a credit report. And then that report is going to be used to create a score. And it's one big revolving door that kind of goes into how it's being used, and to the catch-22 I'll get to right after this slide. So it's used in a lot of things now. So it's not just applying for credit cards. It's not just for it's not just getting a home. It's not just buying a car. Excuse me. It's for setting up utility accounts. It's for getting a cell phone. It's for buying insurance. It's for getting certain jobs. A lot of jobs where you might need to handle money, they might check your credit report. Renting an apartment, the landlord may actually check your credit report beforehand to see, okay, is this person likely to pay their rent on time? based on their payment history on their credit report. That's why it's so important to start building your credit early. That's why I wanted to mention these things. Building your credit as early as you can sets you up now versus 10 years, 15 years down the line, when you get into a point in your life where, okay, you're trying to get an apartment or you're trying to buy a home for the first time and you get denied because you don't have any credit history. You don't have a credit card and you don't have any history of payments. So they say, sorry, we don't know if we can trust you to make your payments on time. That's this catch-22 that a lot of people find themselves in. So here's this example. You want to buy a house for a first time, but lenders keep telling you that you don't have enough credit to be approved for a loan. So you don't have enough history on that report for them to make a decision on whether or not they think you'd pay your bills. So they deny you. You try and apply for credit cards to hopefully build your credit, but you're denied because you don't have enough credit. You try and get a car loan, but you're denied because you don't have enough credit. How are you supposed to build credit if you can't get approved for credit? That's this revolving door that a lot of people find themselves in. And it can be very frustrating for the average consumer who's just trying to do the everyday things of life. Getting a car, transportation, finding some place to live, whether that's just renting a place or buying. So, excuse me, my allergies are going a little wild right now. So this is the unfortunate reality that a lot of consumers find themselves in, especially younger adults. Now, this is not to say that middle-aged or older adults can't find themselves in this situation, but I would say this is usually an issue for younger adults. I know this was an issue for me when I was getting out of college. I got my first job and I couldn't get approved for any type of credit. I wanted to buy a car. The only cars that I had purchased on my own were beaters with very little cash. So I had never purchased a car on credit, but I wanted to buy a safe vehicle. So I wanted to get a loan for the first time, and I couldn't get approved on my own. So how do we do this? How do we start building credit when we don't have a history of credit? So here are the options. I think there's 6 of them, 6 or 7. I can't. We'll see. We'll get there. So the first option is getting a secured credit card. What does getting a secured credit card actually look like for people? So this is a type of credit card that requires collateral. What is collateral? Collateral is something that you have given over to a financial institution like a bank or a credit union as security for repayment of a loan, credit card, whatever. And it's to be forfeited or given over in the event that you don't pay your bills. That's what the collateral is. What happens in a secured credit card situation is that collateral is kept in a dedicated account at that financial institution that's issuing the card. The card is secured with that collateral. So usually what happens is these secured credit cards, the limits are a lot lower. You're not getting a $10,000 limit credit card that's secured. I mean, if you just had $10,000 in cash lying around, I mean, good on you. You might not need this course. But usually in these situations, the limit is much lower. This is how I actually started building my credit after I graduated college. I got a secured credit card from a local bank when I was living in Utah, and it was $500. I took $500 of my own dollars, I saved up, and I had a $500 limit credit card, which is very low compared to what you see a lot of other credit cards offering, right? And some people would say $500 is nothing. Like, what am I supposed to spend on a $500 credit card? Groceries. This is an opportunity for you to show creditors that you can pay your bills on time, that you would be an active user of credit, but that you would pay your bills in full and on time. So for me, it was a gas and grocery card. Those are things that I knew I needed and that I would be paying for. So that's what that secured card was used for. To get that secured card, you had to make a deposit with that financial institution that issues the card. And then that limit is the maximum you can charge on that credit card. So mine was $500. Usually it's around $500. It depends on the financial institution you go to. But I think the standard is about $500. It might be more now. I know FDIC, the federal, I never remember, the Federal Deposit Insurance, whoever they are, says that it's still about $500 at this point. But this is what you should watch out for when it comes to secured credit cards. I'm not just going to tell you, I'm going to tell you the pros and the cons of these things. So this is what to watch out for when it comes to secured credit cards. Fees. So secured credit cards often have fees. So they could have annual fees, monthly fees, and other things. So there are some protections. So they cannot charge fees that add up to more than 25% of the credit limit in the first year. Please make sure you read the fine print. Make sure that the fee structure doesn't increase after the first 12 months. Sometimes financial institutions will put that in the fine print. After 12 months, the fees will increase, or suddenly you'll have an annual fee of $95 when it was $0 for the first year. So just make sure you're reading that fine print. Then this next one, credit utilization. If you've been to any of our other credit report and score presentations, you've probably heard about credit utilization. This is really important when it comes to your credit score. And it's something you still need to think about when it comes to any type of credit, especially when it comes to secured credit cards that may have lower limits. So credit utilization is how much of that credit that you have that you're using. So if I have a $500 credit limit, just like I did when I graduated college, and I maxed that out, I spent all $500, that means I'm using 100%. I'm utilizing 100% of my credit. That's not great for my credit score. In fact, that's bad. That means that whatever credit score that I would have at that point is probably going to go down a little bit. That same concept applies to whether your limit is $500 or $5,000 or $15,000. So you always want to make sure your utilization rate is as low as possible. You're paying off those bills. You're making sure you have the lowest utilization rate, or you're paying off your card in full. There's this myth, and we've talked about it in other webinars too, but I'm just going to reiterate. There's a myth that you should keep a balance on your credit cards, and that'll improve your score somehow. That is not true. I don't know who started spreading that myth. I'm not pointing any fingers at credit card companies, but whoever started spreading that myth, really, that just costs consumers money. Because if you're holding a balance on your credit cards, that means you're just going to end up paying interest in the long run, right? So you're not building a good score with that. You're not increasing your score. If anything, if you're charged interest, that now means your utilization rate's going up and your score could go down potentially. So just keep that in mind when it comes to any credit card, but especially secured credit cards that have a lower limit. And missed payments. This goes for any type of credit, but especially when it comes to your first credit card and you're building your credit, you got to make sure to pay the full amount that's due each month. This applies to every payment on everything. You should be paying the full amount. But if you're just building your credit, you don't want to miss these payments, okay? And reporting. Check your credit report and make sure it's being properly reported to the credit reporting agencies. If you're starting to build your credit, you want to make sure that the credit reporting agencies are getting all of those payments. They're seeing all of those payments you're making and it's being properly recorded. So you're getting credit for all of that, okay? So just keep that in mind. Option number 2, get a credit building loan. So these are usually installment loans. Some people might call them micro loans. So they're usually $1,000 or less. You repay them through regular scheduled payments, but the payment period is usually shorter because they are much smaller than other installment loans. So they run you 6 to 12 months usually. Now, this is not like a payday loan. This is not like another type of loan, a title loan, things like that. This is a loan that you would go to a bank for or a credit union. So this is an installment loan that you're going to an actual financial institution for. So you would repay them over this period of time. What I do want to say before I go on to the cons of this is you just want to make sure that they might require a deposit of this on this sometimes. So you might be required to give some money up front, things like that. So what to watch out for when it comes to credit building loans is the interest rates. This is the thing really to watch out for the most. So be sure you can afford to repay the loan, obviously, but mostly when it comes to the interest. So the rate really could affect how much you're paying on a monthly basis. And if that rate is really, really high, make sure you can pay that back in the shortened period of time. I mentioned in that last slide, these are shortened payment periods. This isn't going to be like a 5 to 10 year repayment plan. This is going to be a 6 to 12 month because it's like a micro loan. So just know that the interest rates could be a little bit higher, and that's going to affect the amount you're going to be paying every single month. Remember, even if the loan is deposited into your account and you make the loan payments from this deposit, you'll still need additional money to cover the interest. So even if you're using the money you got from the loan, you're still going to need money to cover that interest. Missing payments. So again, this may seem obvious. While regular on-time payments can build your credit, missing or late payments are going to ruin it, not just harm it. There's a common misconception that I've spoken about before too, where people think, oh, well, the first missed payment isn't going to hurt me as much. They think it's like kind of gradual downfall. So the more they miss, the more their credit will go down. It's actually that first missed payment that hurts you the most. So you're going to take a deep dive with your first missed payment, and then you'll slowly go down the more you miss after that. So please, please, please be sure you can afford the payments before taking on the loan. And again, reporting, make sure the credit reporting agencies are reporting it properly so you're getting credit for the payments that you are making. Option number 3, so become an authorized user on someone else's account. This provides you with a credit card in your name, but someone else owns and is responsible for the account. If the primary account holder uses their account responsibly and has good credit, it may provide a slight boost to your credit scores. The thing about this is not as effective as having your own credit. It is going to help somewhat, but it's not as effective as getting your own credit card or your own secure credit card, your own loan, because you are going off of somebody else's account. But it can be helpful and a way to start. So this is an option. What to watch out for when becoming an authorized user on someone else's account. This is where things can get a little tricky with this. The credit reporting agencies need to know that you're an authorized user on this account and make sure that they're reporting it accurately for you to get that credit. A lot of times it goes off without a hitch, but sometimes you might not be put on as an authorized user and you might not be getting the credit that you need to or that you think you should to be building that credit. So just check your credit reports once again and make sure everything is going on your credit report as it should be. This is the key one here though. Missed payments by the account holder. Because you are kind of piggybacking on somebody else's account, if that account holder has late or missed payments, that can affect your credit. So you need to make sure that the person who owns the account is a responsible person who's making their payments, is always paying on time, and has good credit. Of course, things can come up and people fall on hard times, but you want to make sure in the beginning that you're both on the same page, because I've heard some horror stories from people who have done this type of thing where all of a sudden the account holder just doesn't pay their bills and then they both end up in a bad situation. So just watch out for that if you're considering this as an option. Get a cosigner. This is similar but different than the last option. So this is when you ask a friend or a relative who has good credit to cosign on your loan. A cosigner promises to repay the loan if you do not. So this is a good option because it's putting it in your name. So the credit is in your name, but it is putting the onus on somebody else if you don't pay your bills. These are the things to watch out for when you get a cosigner. This is the biggie here. What if you don't pay back the loan? Your cosigner is now responsible for the payments. This could damage their credit a lot. Well, first of all, your credit's going to be damaged a lot, and then their credit's going to be damaged a lot. And most likely your relationship is going to be damaged a lot. So just keep that in mind as you're considering this as an option. You want to be absolutely sure that this is something that you can pay for, that the payment is something that you can afford, and that this is a relationship that you think can make it through something like co-signing on a loan. That's a big decision. That's a big commitment for you and a co-signer to make together. And then again, reporting. I know I've said this 4 times already now, but you always want to make sure that the lender is reporting the payment information correctly. And in this situation, that they're reporting it correctly for both you and the co-signer to the credit reporting agencies. Option number 5, apply for a credit card at a store or a gas station. Now, as we get to these last couple of options, I'm not saying that this is the worst option, but I'm going to give some caveats here. So applying for a credit card at a store and a gas station can be a good option because these typically have a lower credit limit, which is similar to that secure credit card, but they have a higher annual percentage rate. They have a higher interest rate, usually a much higher interest rate. One good thing about these credit cards is they may be easier to get approved for than other types of credit cards, just because they're at a certain store or gas station, whatever it may be. So these types of cards may be easier to get approved for than really any other type of card. So that's why this might be a good option. Here are some things that I really want people to think about before they go out to Old Navy or TJ Maxx or wherever else, Murphy's Express, and get a credit card. The interest rates are going to be high. So please, if you are going to open up these types of cards, you got to make sure that you can pay back what you spend on this in full, not just the minimum payment. You got to make sure you got that cash in your bank to pay off that full balance at the end of the month, or else you're going to be hit with a huge interest payment at the end of the month. That's where people get into a lot of trouble with these types of credit cards, because they think, oh, well, I don't know why I'm thinking of Old Navy, but Old Navy is the one that came into my head. I have an Old Navy credit card. I'm going to go shop at Old Navy, and I get all these points, and I'm getting all of these discounts, and it just seems like such a great deal. I'm getting such a screaming deal out of this. And then they spend way more money than they usually would. And then at the end of the month, they actually don't have enough money to pay off what they spent at the beginning of the month. And then they get hit with 29.99% interest on however many hundreds of dollars they spent on clothes at Old Navy that month. So you want to make sure you keep that balance on the card as low as possible. And just be aware that these are going to have high interest rates. And again, you want to make sure everything's being reported correctly. I really don't think these cards are good options for people who have a difficult time budgeting. If you are somebody where a credit card or a gift card or cash or money in general burns a hole in your pocket, I don't think this is a good option for you. The only reason I say this, and I bless my husband's heart, I love the man so much, and I hate to call him out like this, but money burns a hole in his pocket. And he cannot have a credit card like this because he's like, oh, it's such a good deal though. It's such a good deal, so I bought it. If he sees like a coupon or he sees a 20% off, he's like, well, I had to buy it because it was a 20% off deal. And I'm like, but did we need that? So if you're not good into budgeting and you're not the type of person that can be fiscally responsible, this might not be the best option for you. Just putting that out there, okay? And then option 6. So you can make a large down payment on a purchase and negotiate a loan for the balance. So this is going to be with a lender. This isn't going to just be like any type of purchase. So you're going to offer to make a large down payment. And then the lender will approve you for a lending application. And you won't have to borrow as much money. For example, you're buying a used car for $5,000 and you have enough cash, you might consider making a down payment of $1,000 to $3,000 and then repaying the loan as agreed. You can help build your credit history. So instead of just paying for the car outright, you make an agreement with the car dealer like, hey, I've got the cash, I have the collateral, but I really want to build my credit here. Could you give me a better credit limits or better credit terms, because I have the collateral here. I'll make a larger down payment and then I can just pay the rest on a payment plan. That might work to start building your credit. What to watch out for though when it comes to this is interest rates. When you're negotiating, see if you can negotiate interest rates also. So don't just say, okay, yeah, I'll take whatever interest rate you'll give me. See if they'll also negotiate interest rates to go down because you have that collateral up front. You got the $5,000 for the $5,000 car. Let them know that. Just say, I'm looking to build some credit here. Could you also bring down the interest rate too? That's something you should be doing as a consumer in general, is advocating for yourself. If you're making a large purchase, whether it's a car or a house, and you're doing it on a loan, never just take the first offer that you get. Always look at those interest rates and then go shop around. Go to a next lender and say, hey, this person offered me this. Can you give me a better deal? That's just a good spending practice in general, a good shopping practice, especially when it comes to credit. So loss of an asset. This is unique to this type of credit building strategy. So the loan is likely to be secured by the asset that you're buying. So if it's a car, that would be the asset. If you don't make your payments on time as agreed, that asset may be repossessed. So that car could be taken away if you don't make your payments on time. And then again, the reporting. This is on every single one. You want to make sure that your credit reports are showing all of your payments correctly, that the lender is regularly updating those types of things. And this is option 6, but it's actually option 7. And this is the last one. Create an alternative credit history. This one is the most difficult one. So creating an alternative credit history can work for some people, but it's not a guarantee. So I just want to put that up front. So many of the bills you pay are not included in your credit history. So utility bills, cell phone bills, your payments to your landlord if you're renting. So those aren't included in your credit reports. But in the last, I'd say 5 to 10 years, it's become a little bit more popular for people to request for those payments to be shown on their credit reports as a way to show creditors that they make timely payments. So this can create a record of showing your timely and regular payments of other bills. The FDIC, and by the way, I attached the slides to this presentation. You can download them. For whatever reason you can't figure out how to download them, you can just email me. My email is the one associated with this webinar. I can send them to you. But if you can download the slides, you'll just be able to click on this. But I'll click on it so we can see it real quick. So this gives you a tool of you are able to enter in the different types of payments that you're making, and it gives you an opportunity to kind of estimate how frequently you're making payments, how long you've been doing that, and then that way you can kind of estimate, like, is this worth it? Should I request for my credit reports to have this type of information on it? Now, again, this is not guaranteed to help build a credit history, but it can, and it has for some people. So the reason I say this is some businesses will not accept alternative credit history in place of a credit report or scores. If you don't have a score at all because you don't have a credit history, this may not help. There are some institutions that say you don't have a credit history of credit cards or anything like that to build a score, then we're not going to take your rent payments as a replacement for that. The other thing is you're going to need a lot of evidence. So you're going to need to have all the evidence to back up your claims of those timely and regular payments. So receipts, statements, letters from the businesses that you pay regularly. So it's going to take time and effort for you to put together the evidence to do this. But if it's something that you want to do and look into, then, just make sure that you got all your receipts. Again, I just want to remind you, if I didn't cover, because a lot of people really want to hear about the scores. Today wasn't about scores, but we got it on the YouTube. Just wanted to remind you, if you missed the very beginning where I talked about it, you can go to our YouTube and watch the whole hour presentation that goes over how your score is calculated, and really what goes into the score, what affects it the most, along with our other credit reporting information. Now, here are a couple free resources. So I mentioned the Federal Deposit Insurance Corporation. That's who they are. What a mouthful. But they have some fantastic resources. So what I wanted to show you is, this is for people of all ages. It's How Money Smart Are You? I love these resources that they have, because it's not just for kids, but they've kind of gamified financial literacy, and they actually have a whole section on credit scores and credit reports down here. They have a whole section. I love how they divide this out: earn, spend, save, borrow, and protect. And the borrow section has this one game on credit reports and scores that I think is fantastic. Again, this link is available if you download the slides. Really great resource. And then we have this free guide that you can order from us. It's on our website too, the credit reports, what they are and why they matter. I'll show it to you real quick. So I actually was the one that wrote this whole guide, so I know a little bit about it. It goes over what's on your credit report, how to get your credit report, why you should be checking it, how you can increase your score, the myths, credit counseling, scams, all this stuff. But this is the page that I hear the most, that people find the most helpful, is the credit report checklist. This is something that you can actually go through with your credit report and check off. Okay, here's the date that I looked at my credit report, and is my name correct? Yep. Is my social security number correct? Yep, it is. And go through and make sure everything is yours. It goes through the account information. Like, are you listed as a cosigner on a loan? Is this correct? Are accounts that you close listed as closed by the consumer? Is negative information reported? So it goes through all the major highlights of your credit report, including zero balances, things like that. So if you want to see this on our website, you can download it on our website for free. It's actually just on our website, consumer.sc.gov. And you can go to consumer resources, and it's on the money and credit page. Or you can actually just order them from us for free. We'll send them to your door. The link is here in the slides too. Make sure to follow us on all of our social media and go to our YouTube channel with our 47 webinars that are on there. And again, all our publications are free. Everything we do is free. Thank you so much for attending our webinar today. Hopefully it was helpful. I hope you have had a good time. You learned something, and I hope you have a good rest of your day. Thanks so much. Bye.